Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at stock name.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
Okay.
We are really dissecting a fascinating story today. It's one of strategic transformation.
Right.
This company is placing a really high-stakes bet on fundamentally changing who they are.
Moving from what to what, exactly?
Moving from, a pure research and development organization to a critical defense and high-margin industrial solutions provider.
That sets the stage immediately then. We're looking at a story of, what, redemption? Or maybe just a massive gamble.
It could be both.
Because if you just glance at the financials, it looks challenging. This company is still pre-scale, very revenue light, and it's operating at a loss.
A consistent loss. Yeah.
For most investors, that's not a buy sign. That's a warning sign.
And rightly so. But you really need to understand the nature of those losses. This is the core insight here.
Okay.
These aren't losses driven by, say, a lack of demand or some weakness in the market. They're losses from aggressive strategic investment. Management is pouring capital into R&D and scaling up their SG&A functions.
So their sales and administrative costs?
Exactly. All to commercialize these new industrial and defense offerings.
So the bet is that today's losses are actually tomorrow's profits, just waiting to be unlocked.
Precisely. It's a true scale-up gamble, not just a honey pit.
Right.
And this sets up the classic scenario of operating leverage.
Explain that a bit.
Well, and it's a big if, but if the revenue growth from these new sectors finally hits, those investment costs, which are mostly fixed, they won't rise with it.
So more of each new dollar of revenue falls to the bottom line.
A huge, disproportionate chunk of it. It could radically transform their profitability almost overnight.
That makes this strategic pivot the absolute centerpiece of the thesis then. It's not about their old R&D projects anymore.
Not at all.
Yeah.
The whole focus has shifted to industrial laser systems and, most critically, defense and security.
And these are just higher margin businesses to be in.
Absolutely. Higher average selling prices, or ASPs, and much better margins. We're talking about use cases that demand extreme precision, like metal 3D printing or advanced welding for critical components.
And they're not just hoping this happens, they're engineering it with acquisitions.
That's the vital step. It accelerates the whole timeline. The recent agreement to acquire Orbit is transformational.
How so?
Management is pretty clear. This moves them from being just a hardware OEM, a company that sells
a box.
Yeah, selling a box, to becoming a full-blown solutions provider focused on integrated defense. They're selling operational resilience now.
Which is much stickier.
Exactly. Orbit immediately expands their defense and security hub, brings in an existing revenue pipeline, and it unlocks all these cross-sell opportunities. It makes them so much harder to displace.
Okay, we've talked about the big strategy, but a great plan means nothing without the cash to make it happen. Before we get into the tech, how's their financial runway?
The balance sheet is what you'd expect for a microcap like this. Think of it like a pro cyclist.
Yeah.
Thin, fast, efficient.
Built for speed, not comfort.
That's a great way to put it. They have a modest cash balance, but crucially, they're avoiding any large near-term debt.
Which reduces the immediate risk, but it definitely means they're reliant on the markets for capital.
That is the model, yes. They rely on capital markets, PAPs, strategic partners.
Yeah.
Free cash flow is negative, but that's a deliberate choice.
Right. They're prioritizing growth and building that competitive moat over everything else.
Everything else.
So let's talk about that moat, the technology. What is their competitive advantage? What makes their laser so special?
Okay, this is where it gets really, really interesting. Their primary moat is their proprietary high-power blue laser technology.
Blue laser.
And this isn't just a small improvement on standard lasers. It's a fundamental leap.
Why blue?
Blue lasers are optimized for metals that are notoriously difficult to work with. Highly reflective metals like copper, gold, and aluminum.
And copper is, it's the lifeblood of electrification. EV batteries, power electronics?
Precisely. Standard infrared lasers struggle because copper just reflects most of the energy. The blue laser, though, has a wavelength that copper just soaks up.
So it's more efficient.
Dramatically. It allows for faster, higher quality welding with way less energy waste. For, say, an EV battery maker, this means they could produce maybe 30 to 40% more power packs an hour.
Wow, that's a technical advantage that translates directly into a market advantage, and it's protected.
Oh yeah, It's protected by a strong portfolio of patents and IP around the whole system. It's not easily replicated.
So they have the superior hardware. But in defense, it's not just a tech race, it's a network race. How are they integrating into that ecosystem?
That's the synergy from the Orbit acquisition and their alliance with Maddox Defense. They're creating an integrated defense and security hub.
So they're not just selling a better laser anymore.
No, they're blending that hardware into mission-critical systems. It makes them harder to displace. You're not just a vendor, you become a strategic partner.
Okay, let's shift to the stock itself, the technicals. It's a microcap, it's been volatile. Where's it trading now?
It's been in a tight range, around 23 to 25 cents. We've seen these sharp, 20–30% swings on heavy volume.
Which is classic for this kind of stock.
Classic microcap accumulation. To some, it looks like noise, but to an analyst, it often looks like an early-stage bottoming process.
So the volatility is the price you pay for the potential upside. The long-term trend looks bearish, but are tactical signals pointing to a bottom?
They are. If you look at the MACD, for example, it's suggesting momentum is finally turning positive after months of accumulation.
So bigger players might be stepping in.
It suggests sophisticated interest is returning, yes.
Yes.
Tactical models are now pointing to positive price action over the next few weeks.
What kind of price action? Where could this be headed if that thesis plays out?
Near-term forecasts are looking at a potential rise toward 40 cents. The average 30-day target from a few technical views sits around 36 cents.
So that's a 50–55% potential upside from here.
A significant upside, yeah. It reflects a clear rebound thesis.
That's definitely asymmetric. Where should people be watching for support and resistance?
Key support seems to be clustering down in that 20 to 22 cent zone. That's where the buying has been really strong on any dips.
The floor.
That seems to be the floor the market is accepting. On the upside, you'll see resistance in the 30 to 40 cent band. Breaking 40 cents would be a really decisive signal.
And what about momentum? Is there fuel in the tank for a move like that?
The momentum signals are actually pretty neutral, which is kind of ideal.
Room to run.
A lot of room to run. The 14-day RSI is sitting in the mid-40s, so it is nowhere near overbought.
Okay, so let's talk catalysts. What news are we waiting for in the next few months to push this thing toward those 36–40 cent targets?
Well, there are a few drivers. First, just the positive sentiment from the Orbit acquisition and the Maddox Defense Alliance. That's huge validation.
And you mentioned they cleaned up some regulatory issues.
Yes, and that is so underappreciated. The resolution of the NYSE American Compliance Warning removed a huge overhang. It lets investors focus back on the story.
So looking ahead, say, the next 1 to 3 months, what are the key items to watch for?
Number one is the Orbit acquisition close and any integration updates. We need to see that it's going smoothly.
And proof of concept?
Second, yes, proof of concept. Any joint announcements with Maddox Defense about program wins, even small pilot programs, would be massive validation.
And then, of course, the earnings report.
That's the big one. Consensus expectations are probably very low. So if any early revenue from these defense initiatives shows up, it creates a very low bar that could be easily beaten.
Which could trigger a spike. Okay, that's the bull case. But M&A is tough. For a company that's this revenue light, can they actually pull off this integration?
And that is the core execution risk. It is absolutely the backbone of the bear case. They're still dependent on external capital.
Right.
If that integration stumbles, or if those partnerships don't turn into real recurring contracts fast enough, dilution is a real possibility. They need near flawless execution.
And then there's just the nature of their target market.
Exactly. Adoption risk. Defense procurement cycles are notoriously long and bureaucratic. Even with superior tech, it can take years for the Department of Defense to sign those big, sticky contracts.
So you need patience.
Patient capital is non-negotiable here.
And we have to circle back to the volatility itself as a risk.
Absolutely. As a microcap stock trading around a quarter, it's extremely volatile. You have to be prepared for severe drawdowns, 30% or more, on even minor news.
But that volatility is also what enables the upside.
Cuts both ways, exactly.
So let's put this all together. What is the elevator pitch for stock name?
The pitch is simple. This is a high optionality, high beta play with highly asymmetric upside. It's a pure play on proprietary blue laser IP, coupled with the growing need for defense and critical infrastructure resilience.
So you have a depressed valuation paired with these really transformative strategic moves.
Precisely. And that creates a setup where even small fundamental wins could dramatically re-rate the stock. The real-time horizon here is longer term, think 12 to 36 months.
So the takeaway is, This is for investors who are comfortable with microcap volatility and execution risk, but it offers that multi-bagger potential if the defense thesis plays out.
The story here truly hinges on converting that superior blue laser technology and newly formed defense infrastructure into sticky, recurring government and industrial contracts. If management can bridge that gap from R&D losses to scalable defense revenues, the current valuation acts as a very, very low starting line.
The question you have to ask is, do you believe the tech and the strategy can overcome the hurdles?
That's it. That strategic shift makes it one to watch very closely as those integration updates start rolling in.
Absolutely. And if you enjoyed this detailed look at stock name, make sure you hit that subscribe button so you don't miss our next stock analysis. Thank you for tuning in to Smart Wealth with Joshua.